72,000. I mean, just let that number sink in for a second. For decades, the very idea of the Japanese stock market hitting 72,000 points, well, it sounded like pure financial science fiction. But in June 2026, the Nikkei didn't just approach that milestone, it blew right past it with explosive energy. Welcome to today's Explainer. We are diving headfirst into one of the most unbelievable roller coaster rides in modern financial history. We're talking about the Tokyo market in June 2026. This isn't just, numbers moving on a screen. It's a real-time collision of massive geopolitics and micro-level tech panics. So let's just get right into it. Here is the central mystery we are unpacking today. How exactly did the Japanese market pack on thousands of points in just a matter of days, totally defying history, only to suddenly, and I mean violently, reverse course? We are going to quickly break down the exact catalysts that ignited this rocket, the hidden market mechanics that acted as its fuel, and the invisible wall it eventually smashed into. Which brings us to Section 1, the perfect storm, peace hopes, and the BOJ. To really grasp the climax of this story, we've got to look at the crazy macroeconomic winds pushing the market up. It was literally a perfect storm of positive news. Just look at the sheer speed of this timeline. In mid-June. On June 15th, news hits that the US and Iran are actually moving toward a provisional peace agreement backed by mediators. The very next day, June 16th, the Bank of Japan wraps up its highly anticipated policy meeting. And then, fast forward to June 23rd, and the Nikkei is smashing through the 72,000 barrier. The whole shebang happened in just about a week. Let's actually pause on that Bank of Japan meeting for a second. The BOJ officially raised its policy interest rate to 1.0%. Now, normally, you think a rate hike would throw cold water on a hot stock market, right? But the exact opposite happened. Why? Well, because the market had basically been holding its breath. By finally hiking the rate to exactly 1.0%, which everyone anticipated, the central bank cleared out all the uncertainty. And if there's one thing investors love more than cheap money, it's certainty. Once that event passed without any negative surprises, buyers felt totally safe jumping back in. So that BOJ relief happened at the exact same time as these massive global tailwinds. The US-Iran peace accords drastically cooled down Middle East tensions. That made crude oil prices take a nosedive, which wiped out a huge inflation fear. At the same time, because the US Fed was still keeping rates relatively high compared to Japan, the yen weakened past 160 to the US dollar. For Japan's export-heavy market, a weak yen is absolute gold. Throw in some solid stabilizing US consumer price data, and Japanese stocks were basically irresistible. And to put a real concrete number on that geopolitical relief, 12.5 million. That is the exact number of barrels of oil that safely sailed through the Strait of Hormuz in a single night after the US-Iran provisional agreement. Global energy costs just plummeted. The fear of runaway inflation, poof, gone overnight. All right, moving on to Section 2, breaking the 72,000 barrier. With the macro fears totally neutralized, the market went absolutely parabolic. But, and this is key, it wasn't some broad, even rally. Look at the heavy lifters on this list from June 23rd. Tokyo Electron alone dragged the Nikkei up over 245 points in a single day. Fujikura, a fiber optics giant, added over 201 points. Then you've got iBiden and SoftBank Group right behind them. The market was completely obsessed with literally anything touching the AI and semiconductor supercycle. The momentum was an absolute frenzy. Take Disco Corporation, a massive player in semiconductor manufacturing equipment. They didn't just have a good quarter. Their stock price soared an unbelievable 3.8 times from its April lows to its June peak. I mean, we're talking about a major corporation nearly quadrupling its valuation in just months. It was total FOMO, a complete buyer's panic to get in on the AI revolution. Which leads us to Section 3, the fumigage effect. Fueling the fire. Beyond just the eager fundamental buyers, there was this hidden mechanical force acting as rocket fuel under the market. In Japan, they call it the fumigage effect, basically a massive short squeeze. Imagine a group of investors who bet a stock is going to crash. Those are your short sellers. But instead, the macro environment gets better and the stock rockets up. These guys start hemorrhaging money. To stop the bleeding, they have literally one choice. They have to buy the exact stock they bet against. This forced buying pushes the price up even faster, trapping more short sellers, and it creates this explosive, crazy upward loop. You can actually see the fingerprints of this fumigage trap right here in the lending ratios. A lending ratio basically compares margin buying to margin shorting, and anything below 1.0 means heavy shorting. Look at this. McDonald's Japan at a crazy 0.10 and Skylark at 0.11. Even massive blue chips like Fast Retailing and the Japan Exchange Group were way below 1.0. All these household names were heavily shorted, and when the market surged, those short sellers got totally trapped. Their frantic buying was like pouring gasoline on an already raging fire.
Okay, so you have solved geopolitical crises, a comforting central bank, an AI tech boom, and a massive short squeeze, all shoving the Nikkei past 72,000. It felt unstoppable. But what happens when an unstoppable force suddenly hits an immovable object? What on earth stopped this historic rally dead in its tracks?
That brings us to Section 4, the US Tech Tremor. The bad guy in our story didn't actually come from Tokyo. It came from across the Pacific. Just when the Japanese market felt totally invincible, this rapid-fire sequence of negative news shook the global tech sector. First, top-tier AI researchers leave Alphabet for their rival Anthropic. That sparks immediate fears about a brutal talent war. Then, a broader, chilling realization hits the market. Are these massive hyperscaler AI investments even sustainable? Companies are dropping billions on AI chips with no clear path to profit. To make matters worse, reports out of Korea say SK Hynix is cutting back on high-bandwidth memory chip production. And finally, the US Fed suddenly hints at a much more hawkish stance. Just like that, the AI supercycle spell was completely broken. Almost overnight, the narrative suffered this violent whiplash. On the left side of the pivot, you had all that macro optimism driving the rally. Global peace, central bank certainty, a weak yen. But then, bam, the market slams right into the right side, micro panic. Investors totally stopped caring about world peace and started freaking out over the granular details of AI chip manufacturing, corporate talent retention, and cautious earnings outlooks. Here is Section 5, the aftermath. Gravity returns. The resulting volatility over that historic 24-hour period on June 25th and 26th was just staggering. Let's look at the numbers. In mid-June, we were sitting at a base of roughly 67,400. Then came that insane 3,191 yen surge, peaking incredibly at 72,366, or over 73,200 on the future side, around June 22nd and 23rd. But the very next day, triggered by that US megacap tech sell-off, we witnessed an absolute bloodbath, a massive 2,700 yen drop. Thousands of points were wiped out in a relentless algorithmic cascade. High-frequency trading systems just automatically dumped positions, which violently accelerated the crash and completely trapped all those retail buyers who bought in at the absolute top. It dragged the market back down to the 69,400s by the 25th. All that wealth, all that momentum erased in an instant. And the collateral damage? Oh, it was very real. It wasn't just the AI chipmakers taking the hit. The contagion spread everywhere. Gaming giant Nintendo, a company fundamentally separate from the whole enterprise AI race, saw its stock plunge below 8,000 yen for the first time in 17 months. Why? Because investors suddenly panicked about the cost of memory chips for consoles and overall profit margins. When high-frequency trading algorithms smash the panic button, the sell-off simply does not discriminate. Which leaves us with this final provocative thought. We watched macro optimism inflate one of the greatest short-term rallies in Japanese history, only for microtech anxieties and unforgiving US-triggered trading algorithms to brutally pop it. So, what's your takeaway here? Is this massive tech pullback just a temporary blip? Or are we seeing the end of the AI-driven supercycle? And honestly, more importantly, as we enter this crazy era where HFT algorithmic cascades can wipe out thousands of points in a matter of hours, have you set strict automated stop losses to protect yourself? Because that's the question every investor has to answer right now. Thanks so much for joining me on this explainer, and I'll catch you on the next one.